2012 was characterized on the one hand by improved fruit exports from South Africa, which led to increased packaging sales of fruit boxes, as well as a weakening of the rand by 13%, which led to the replacement of imported raw materials, which we benefited from. On the other hand, we saw muted GDP and consumer spending growth in 2012. We also saw continued upward pressure regarding prices or costs such as electricity, labor, transport, and administered costs, which put a lot of pressure on our business. So despite all of those challenges, we're very pleased to see a revenue growth in the business of 10.9% to 6.8 billion rand. We saw underlying operating profit increase by 11.6% to 585 million rand, driven on the one hand by the increased volumes, and on the other hand by stringent cost control and productivity improvements within the business. In the paper business, we saw our revenue grow by just over 10% to 5 billion, operating profit by also just over 10% to 562 million, and our margins remaining more or less the same, which we're very pleased for under these circumstances. In the plastics business, we saw our revenue growing 12.8% to 1.8 billion rand, and our underlying operating profit growing in that business to 117 million rand, which represents a 16.7% increase on the prior year. And I think that illustrates the progress that we are making in the plastics business in terms of optimization and development to return it to profitability, which we believe over time will be acceptable. We still have margins in that business which are suboptimal, but good progress is being made. In terms of return on capital employed, which is a very important measure in the business and an ultimate measure in some respects, that's up at 16% from 13.8% in the prior year, and 16% certainly above our 15% through the cycle target. We're very pleased that our board has declared a final dividend of 50 cents, up 25% on the 40 cents final dividend of last year, but overall the dividend for the year of 70 cents is up 75% on the 40 cents of the prior year, which we're very pleased by. Gearing is down to 29% from 35% the prior year, and our net debt is just over 1 billion rand, down from 1.3 billion the year before. In terms of the outlook, we expect GDP and consumer spending growth for the period ahead to remain muted in South Africa, and we also expect the continued upward pressure in terms of the costs I mentioned earlier, such as transport, electricity, labor, and administered prices. So with that, we expect the trading environment to remain very competitive. Despite that, we'll continue to focus on the optimization efforts within our business, look for new business, and continue to invest to make sure we remain cost competitive going forward. We'll continue to focus on our strategy, which has delivered well for us up until now, and we believe that strategy and the resilience that we've shown in the past and will continue to show positions us well in the sectors in which we operate.